This is Money Talks. I'm Greg Vogel, Portfolio Manager at GKV Capital Management. Are we in an investment bubble? Yes, no, maybe. Investment bubbles are easy to identify with the benefit of hindsight. In real time, the determination is very subjective. Bubbles are only realized after the bubble bursts, but there are warning signs. It comes down to expectations versus reality. Revolutionary technologies are exciting. It's easy to get carried away with all the possibilities. Often the opportunities are real, but if the expected return fails to materialize or takes longer than anticipated, if there is great enough disconnect between expectation and reality, valuations need to be adjusted. Pop. So the best we can do in anticipation of a potential burst is to draw conclusions from past experience. Although history doesn't repeat itself, it often rhymes. The last truly major technology revolution was the build-out of the internet in the late 1990s. I was a software industry analyst and managing director at Bank of America Securities. I covered Netscape's IPO, Microsoft's antitrust battle, and multiple startups that didn't make it into the new century. But tremendous wealth was generated. Several now trillion-dollar companies emerged from the dot-com boom and bust, including Google, Meta, and Amazon. The internet did change everything, but not necessarily the way many investors expected. Today, it's hard to imagine life disconnected. Internet service is as essential as electricity. We've had quite a few major technological revolutions. Electricity, the telephone, television, integrated circuit, the microprocessor, and personal computers. With each new technology, a couple of new winners emerge and quite a few businesses fail. The development of the internet, some jobs were reduced or eliminated. My children never knew encyclopedia salesmen that went door to door. My first job as a paper boy is no longer. The professional travel agent has given way to the travel influencer. But for most professions, the internet has enhanced what people were already doing. Instead of calling to ask about their investment performance, clients can look at the GKV app on their phone. So back to the question at hand, are we in a bubble? I think there are two types of investment bubbles. The first I'll call speculative bubbles. These develop out of nothing more than a fad coupled with scarcity. Tulips, Beanie Babies, NFTs. These assets only appreciate in value if someone else comes along willing to pay more. There is no intrinsic value. This isn't true of performing investment classes. Stocks, bonds, and real estate generate cash flow. You get paid for the use of your capital. And using relatively simple math, cash flows determine an objective value. Valuations of performing assets can develop into an investment bubble, however. It goes back to expectations or possibilities versus reality. If the expectations of future cash flows, future earnings get too optimistic, values will get readjusted lower when reality sets in. We believe that the development of artificial intelligence is revolutionary and will have a profound impact on virtually everything over time. We also believe that it's not yet clear what business models will develop and who the long-term winners will be. We're still in the early stages. Shares of Apple languished early this year due to lack of artificial intelligence capability. But it's early. The first iteration doesn't always work out. Remember the Apple Newton, the Palm Pilot, the BlackBerry? They were early smartphones, and they were too early. What is clear is that the infrastructure build-out has to happen first. We're focused on companies that have proven business models providing the necessary components to enable AI applications. The company that spends the most on CapEx to build data centers is not necessarily going to be the best investment. Although America Online was a premier internet service provider, you were better off owning shares of Cisco. We are focused on the AI infrastructure companies, the semiconductor companies with the chips required to process large language models. The data center companies, including software storage, electronic components, and electricity. We're less sure of what the hyperscaler business model will look like exactly. What will be the margins for providing AI computing capacity? If AI capabilities get woven into everything, will it be the software vendor that sells more software, or will the AI provider be the principal beneficiary? So again, bubble or no bubble, there are some signs of irrational exuberance in the markets, which gives us pause that expectations may be departing from reality. We are concerned with some of the circular self-dealing that is going on in the industry, effectively increasing revenue. NVIDIA investing in OpenAI, which enables OpenAI to purchase more NVIDIA processors. And there is rampant speculation in other areas. Tesla is not being valued as a car company. If personal robots, and specifically Tesla robots, will be in every house, then maybe Tesla is cheap. If it's just a car company, the stock will be worth less than half of today's price. If pilotless air taxis are going to be as easy as calling an Uber, then Archer Aviation and Joby are amazing investments. Or maybe their vision of the future is still ahead of their time. Remember the Apple Newton. These bets are speculative. And there are economic risks, although the U.S. economy is resilient. The U.S. economy shows signs of weakness by just about any measure this year. Inflation remains elevated, unemployment has been rising, manufacturing is down, and consumer sentiment is at historic lows. Meanwhile, U.S. government debt is growing, and interest rates are likely to remain elevated. The strength in stocks this year has been mostly limited to communication services and technology, the artificial intelligence opportunity. There are real fundamental justifications for optimism around artificial intelligence. It is apparent that AI will be woven into the fabric of much of what we do. AI will be more than a chatbot or a Google query. We certainly think it's too early to call out the winners. The best bet is to invest in the companies growing revenue and earnings. The companies that did that survived the last bubble just fine. The answer to the bubble question is not binary. Yes and no and maybe are all true. It is not clear yet how business models will change with AI. There are some innovations that are not ready for investment yet, and yet the development of artificial intelligence is a generational change. The opportunity is significant. Now we have to see if the reality matches our expectations. That's all I have for today. For more detail on our analysis, you can download a quarterly update from our website at gkvcapital.com. You can also sign up for our email distribution list to receive our reports directly in your inbox. Thank you very much for watching.